Hello and welcome to AEC Thrive's Hot Markets Day Kickoff to kick off the annual and first virtual AEC Thrive Conference. Today we will dive into which markets are hot and which are cooling as we emerge from the first COVID-19 shocks and regain our footing. We have a jam-packed day ahead of us of interactive dialogue with public and private sector decision makers to learn how to make AEC investment decisions and provide intelligence that you can use to fine-tune your BD strategy for 2021 and beyond. Before we kick things off, I'll cover a few housekeeping items quickly. First, we are going to utilize the CVent Attendee Hub for our virtual conference. From within the hub and under the Sessions tab, you will find all sessions for today. To enter any given session, simply click on the session and then the Join Now button. If you have not already, please download our events app from the App Store by simply downloading CVent Events app and search AEC Thrive and follow the login prompts. From there, you will be able to view the sessions on the go and see all upcoming sessions, set calendar reminders for any sessions you definitely don't want to miss, and we'll visit with our great sponsors. For direct support throughout today and the next few days, for those joining us for AEC Thrive, we have set up a direct email address for any technical support. That email address is thrivesupport@psmj.com. You can connect with us at any time from your attendee hub or mobile app by simply clicking Contact Us at the PSMJ desk under Exhibitors. If you have any questions throughout the session, feel free to ask them at any time and as many questions as you'd like. Simply submit them through the QA box on your control panel. And if we aren't able to get to your question in the live session, we'll follow up post-conference with answers to any questions we didn't get to. Following the conference, you will receive a follow-up email with all the materials from today's sessions, including the recordings of today's presentations, slide decks, and your participation certificate to submit for credits. PSMJ is an AIA continuing education provider, and this webinar has been approved by AIA Continuing Ed for both AIA members and non-members. By attending, you will earn 2.75 learning unit hours or PDH credits. And lastly, but not certainly least, I want to take a moment to thank our amazing sponsors of this year's conference. We could not do this without them. A quick shout out, our 2020 sponsors are Stanbon Ness, AEC 360 by SA Global, Autodesk, Brain Consulting, Uninet AE powered by Clearview, Assured Partners Design Professionals, Planify, Client Savvy, Actions Proof, CX Pilots, the Mink Group, and SMPS. Please join me in giving these folks a big thank you for being here. And please be sure to visit their virtual booths in the exhibit area. Head to the link tab under Exhibitor and click Enter to Win for a chance to win some great prizes, including Maui Jim sunglasses, a $100 Amazon gift card, and more. Each time you click on a sponsor, you will get a chance to win. So make sure to click as many sponsors as you can. Now that we have these items covered, let's dig in. I'm pleased to welcome and to turn the presentation over to Greg Hart with PSMJ to get us started.
All right, thanks, Chelsea, and many thanks. I'd just like to underscore, the sponsors for this event are such a key part. And these are great organizations doing great things for the industry. So absolutely, many thanks to them, and do be sure to check them out through your time with us today. Maybe during one of the breaks, or if you're with us tomorrow and Friday, check them out. I also want to mention one other thing. A really, really, really big thanks to our team here at PSMJ. You don't always see, I feel like we should almost have kind of opening credits and closing credits with these things. I think there's a lot of behind the scenes activity that they make it look easy. They really do. But, when you see how the sausage is made, you realize it isn't easy at all. And of course, this year, we had the added dynamic of switching to a virtual event, which added some complexities also. Chelsea, many thanks to you, to Devin, to Pete, to everybody on the PSMJ team. Great job. I must say, as much as I do enjoy going to Seattle, which is where we would be right now, it is kind of nice not having the jet lag or the hangovers today. We could sleep in my own bed and be raring to go here. So there is that upside. But anyway, hello, welcome. This is our first ever AEC Hot Markets Day. There has been so much transition and turmoil in the industry over the past 6 or 8 months, but what we're really interested here is what's going to happen in the future. Okay, we're really interested in digging into what 2021 might look like. It seems like even still, every time you turn on the news, there's some new kind of dynamic at play. Obviously, there's stimulus talk in Washington. Oh, by the way, it's an election year, so there's just a lot going on, and we're going to try to unpack that as best we could today. And then tomorrow and Thursday, really dig more into kind of some of the specifics and what you do with what you know. One of the comments I've heard quite a bit, especially over the past month or two, are some of the challenges associated with business development in the virtual environment, having to make presentations virtually and even find new opportunities virtually when you're not going to industry trade shows and things like that. So lots of good sessions over today and tomorrow. Of course, we have our award celebrations and all sorts of fun that we're going to pack in. We're going to start things off today with Dave. He's got some hot off the presses proposal activity data. We've got 2 panel discussions. We've got, and this is going to sound like the start of a joke, but it's not. We've got a professor, a municipal officer, a home builder, an AEC tech whiz, a government affairs expert, and 2 super smart executives from an AE firm. What do they all have in common? They're all speaking today in our panel discussions after Dave. So be sure to stick around for what I hope is some great dialogue there. By the way, I just want to mention too, we have a whole bunch of folks on the line today who are not registered for Thrive, for the AEC Thrive event tomorrow and Friday. If you're not registered and you want to check that out, psmj.com/thrive, and you can process your registration right there. We start things off at 11 a.m. Eastern tomorrow with Engineering the AEC Firm of the Future, one firm turned results-based management into peak performance. That's delivered by a fellow named Renz Hayes of structural engineering firm Hayes & O'Neill. Renz is on the leading edge, I would argue, building one of the most forward-thinking engineering firms that I've encountered over the years. Not a huge firm, but really breaking a lot of the preconceived notions of how a firm should be run. In fact, they were virtual long before COVID-19. And Renz always has some great insight on that. He mentioned to us once that in his opinion, moving to 100% virtual due to COVID doesn't create new problems. It just exposes existing organizational deficiencies that existed all along. He's just got some great thinking. So 11 a.m. tomorrow, be sure to stick around for Renz. All right, so let's get things started with Dave. Beyond the pandemic, preparing your firm to thrive in the new normal. For those of you who don't know Dave, he's an amazing resource, of course, for us here at PSMJ, but for the industry as a whole. We're lucky to have him. He's one of the nation's leading authorities on business management for the AEC industry. He's been advising, teaching, speaking, writing, doing it all for decades for PSMJ. And prior to that, he was an executive with Parsons. So not only is he a kind of student of the industry on the business side, he's walked in your shoes at Parsons. He was president of a 1,600-person environmental subsidiary and president of a 120-person planning subsidiary. He knows his stuff, and I can't wait to hear from him. Without further ado, Dave, it is all yours. I am going to stop the share of my screen, and you can take control.
Thank you very much. Let me share my screen. And thank you for that lovely introduction. Can you see my screen, Greg?
I sure can.
All right, well, we got that out of the way. So we're going to talk about today, but really more focused on tomorrow. And I think we're getting to the point in the pandemic cycle where we really can think about tomorrow in a lot more detail. When this thing first started, we did a senior executive briefing, and one of the comments I made is that, hey, everybody's got 2 eyes. And right now you have to keep one eye on the short term and the other eye on the long term. But most people back then were really focused more on the short term than the long term. I think we're past a lot of that now, and we can focus a lot more on the long term. That's really what I want to do here in this presentation. So after this very brief introduction, I want to give you a little background on how COVID-19 has impacted our industry. Spoiler alert, it hasn't been so bad. Then I want to go into our latest data, literally right hot off the press, latest forecasts on market trends for 55 different markets. I want to talk a little bit about beyond that, and after the pandemic, what is the new normal going to look like from a market standpoint? Make a few recommendations on things that you should do based on the data that we see, and then we'll open it up for Q&A. And Chelsea, you want to give them instructions on how to pose questions?
Yes, absolutely. Folks, if you have any questions at any point, there is on the right side of your screen a button that says Q&A. Please type in any questions in there.
So we'll handle as many as we can. I think Greg has given you enough of an introduction on me, so I'll skip this slide. Let me start out and talk about what's happened from a big picture perspective in terms of the impact of COVID-19 on our industry, the AEC industry. This breaks down the economy into different sectors. This is one of the ways that the government breaks it down. And these are the percentages of businesses that were adversely affected by COVID-19. And the national average was a little over 34%. We in the A&E industry are sector 55, and you can see that we're below average. And this is very different from the 2008 recession. A graph that looked like this had us way above the average. We really got hammered. So the good news is this crisis, at least the economic part of the crisis, hasn't been nearly as severe in our industry as it has been in others. And this, I think, shows it pretty well. You can see going back to early 2019, we were right at about 1.5 million employees, total employees in the A&E industry in the United States. This does not include Canada, it's just the United States. And it was rising nicely and steadily until it got to about right here. And then a funny thing happened on the way to the increase. We got hit by the pandemic. It took about a month to kind of figure out what was going on. And then boom, about a 5% plunge in employment. The good news is it was only 5% compared to the 2008 recession when it was more like 25%. I would say that after growing for all the years that A&E firms have grown, I don't know any firm that is really hurt seriously by losing the bottom 5% of their staff. The even better news is the recovery has been pretty rapid. And in fact, we've made up already about half of the losses, the job losses that we had. So from an employment standpoint, you can see that it really hasn't been that impactful on us. Another way to look at it is wages. And if you look at all private sector employees in the United States, you can see here wages were kind of going up, really went up here for a little while, and then boom, took a big drop. And they've kind of leveled off since then at a level about 60 cents per hour lower than what the peak was before the pandemic. Our curve looks a lot different. Instead of a giant drop like that, we had this little tiny blip, and then it just kept right on going up. And so I think this is indicative of the fact that even with all the economic dislocations that we're seeing due to the pandemic, it really isn't depressing wages. And I think that the war for talent that we were all dealing with before the pandemic is coming back, and coming back pretty soon. We also looked at profitability. We did a survey of 100 firms very recently, October 9th, actually. We asked them a variety of questions. One of the questions we asked is, how does your financial performance for 2020 look based on what you're anticipating it end up being compared to what it was in 2019? And the results are very interesting. Only 25% of the industry said that it looked about the same. The rest, about 37% said it looked better or worse. And so what we're seeing now is a very different environment from what we saw in 2019. In 2019, it didn't matter what markets you were in. It didn't matter what services you provided. It didn't matter who your client base was. You were doing well. Virtually the entire industry, with very, very few exceptions, were doing really well in 2019, 2018, and even going back a little bit farther than that. Things have changed. And that's not the case anymore. And the firms that are doing better tend to be concentrated in certain markets, and the firms that are doing not as good tend to be concentrated in different markets. And that's really what I want to talk about now, is what are those markets and what are the differences? So a little quote from Charles Dickens here that I think is very applicable right now. For some AEC firms, it is the best of times. For others, it's the worst of times. And so I want to help sort out which market forces are creating the best and the worst. So the way we look at this is the most leading indicator that's going to give us a prediction of what the industry is going to be like in a year or two from a financial performance standpoint is proposal opportunities. When proposal opportunities start to increase, 3 to 6 months later, backlog increases, another 6 to 12 months after that, revenues increase, another 2 to 4 months after that, cash flow increases, and construction firms actually lag a little bit behind AE firms. So we look really hard at proposal opportunities because they're the earliest indicator. And the way we do that is we do what we call our quarterly market survey. We've started doing this way back in 2003, and we've done it every quarter since 2003. It's a free service to anybody who participates. I'll talk a little bit later about how to get that. We don't ask construction firms for input because really the AE is more on the leading edge of AEC and construction is on the lagging edge. So we really focus on the AE part of AEC. We generally get hundreds of people. In fact, we always get hundreds of people that respond to these surveys. So they're pretty robust. And we use the data to chart what we call plus minus index. And I'm going to explain that here. Here's an example of a question. Are proposal opportunities in the transportation sector increasing or decreasing compared to last quarter? It happens to be one of the actual questions. So here's the way that we calculate the results. Let's say 185 people answered that particular question. And of those, 60 of them said, we're seeing more proposal opportunities this quarter than last quarter. So we count that as plus 1 point. That's plus 60. Another 80 firms said it's about the same this quarter as last quarter. And another 45 said we're seeing fewer opportunities. We count that as minus 1 point. Add all those up, it comes up to plus 15. Divide that by the 185 people who took the survey or answered that question, and we get an index of plus 8%. So it doesn't mean that the market's up by 8%, just an index. If everybody said yes, we're seeing an increase, it would be plus 100. If everybody said no, it would be minus 100. And if the same number of people seeing an increase and a decrease, it's at 0. So anything above 0 is an increase. Anything below 0 is a decrease. So let's go all the way back to just before the last recession. And you can see we were kind of humming along here at an index of plus 13%. And then all of a sudden, boom, the last recession hit. The overall index went down to minus 33. Came back up, and these are just year-end numbers here. And then we've expanded the scale in the last couple of years. I'll talk about that in a minute. And you can see it stayed positive all the way until our first quarter survey, which was in March. And then all of a sudden, it went big time negative. In fact, even more negative than it did during the Great Recession. It went from plus 17 to minus 41. Although we do these surveys quarterly, we were seeing things happening so rapidly that we decided to do some interim surveys monthly. And so we actually have data for every month, even when we didn't do the full quarterly survey. So you can see by May, it was still negative, but not as negative as it had been in April. By June, still negative, but by July, it finally crept up into positive territory, but just barely. Stayed just barely positive in August. And then in September, which we just completed, it's now plus 10%. So the trend here is definitely positive, and we've actually had our first month of significantly increasing proposal opportunities. And this is for the industry as a whole. When we break it down regionally, you'll see that it's very much a mixed bag. Some regions are doing pretty well. Northeast, plus 14. Midwest, plus 10, and other regions not doing so well, minus 12 in the mountain states and minus 12 on the West Coast. Canada is doing the best of all. And you'll see that in my other charts and graphs as well. Canada hasn't been hit nearly as bad either from a health standpoint or from an economic standpoint as the United States has due to the pandemic. I find this particularly interesting because Canada is very reliant on energy, on export of fuel and mining exports and that sort of thing. And in spite of the drop in those commodity prices, Canada is still doing really well. So these are all the sectors that we're going to look at. And I'm going to give you some snapshots now for each of these sectors. Let's start with commercial developers. And here's the dip during the Great Recession, minus 81%. Almost everybody saw a decline in proposal opportunities. It went back positive, stayed positive for a long time. But when we hit March, it went from positive 54 to positive 24 to minus 51. Even farther down the next month, minus 60. You can see there is just a long string of negative numbers. And so remember, this is quarter over quarter. So, way, way down on the commercial developer markets. And if you look geographically, you see the same picture. Some variation geographically. Canada actually was zero. But in the US, all the regions were negative to some degree. But it wasn't uniform. The one place we actually saw strong proposal opportunity was in warehouse distribution. People like Amazon and Walmart and Target are just building warehouses like crazy because of all the e-commerce that they're doing. So even within a sector that overall is really bad, there's some bright spots. And you're going to see this more and more in all the other sectors as well. So here's commercial users. These are people that, like the big box stores, that build their own, not developers. But it's a pretty similar pattern. In fact, it looks very similar to the previous graph. You can see it was positive, went even more negative down to minus 72, and it stayed in heavy negative territory. And it doesn't seem like there's much of a sign of recovery, at least not soon. Looking at the submarkets again, warehouse distribution, same thing. Anybody involved in warehouse distribution, lots of opportunities there. Call centers and data facilities, kind of flat, not terrible. The rest of them, all way, way down. Geographically, again, some regional variations, all negative. Light industrial. So a similar pattern here, but there's a little bit of a difference here because now what we're seeing, here's the big dip in the last recession, went back positive, stayed positive. Here's the dip again, but now this dip was fairly short. And a month later, it got back into neutral territory, stayed neutral. And this last month, it actually went fairly strongly positive. So this market's actually turning up. If you look regionally, all the regions are positive to some degree, Canada being the most positive. And again, warehouse distribution facilities tend to lead the way. And the other two sub-markets are okay, not great. If we look at heavy industry, we see a little bit of a different picture. Here's all the negative stuff going on, similar to light industry. But unlike light industry, which saw an uptick in the most recent month, we haven't seen that uptick yet. It's just kind of cruising along about the flat for the last 3 months. If we break it down into the component submarkets, you can see most of them are negative. Product manufacturing is kind of neutral. Pharmaceuticals, no surprise there, getting billions of dollars from the government to manufacture virus treatments and vaccines. They're doing well. Geographically, a little bit of a mixed bag. There's actually a positive here. Southwest was actually positive here, and several markets that were flat, a few that are kind of down a little bit. So this market's okay, but not as good as the light industrial market. Energy and utilities. So this market is quite different. It had very little dip. You can see it was so strongly positive here for quarter after quarter after quarter. It took a big drop, but it never really went negative to any significant degree. It went down to +1, -3, -4. I mean, these are basically neutral. And then since then, for the last 4 months, we've actually seen month-over-month growth in proposal opportunities in the energy and utility market. If you look at the sub-markets, you can see, again, a very mixed bag. Renewables are doing really well. Utility distribution doing really well. They were doing well before. They're still doing well. Power plants were not doing that well before. They're not doing well now. Pipelines, I think definitely affected by the recession, and telecom and cable kind of neutral. Geographically, again, you can see all the regions are positive except Mountain, which is flat. So there's no negative region. So energy utility market, not too bad. Transportation. If we look at the transportation market, a little different picture. It didn't have a real deep drop, -6, -9, -10. And now it's come back to kind of stable, +1, -3, +10. So this market's maybe a little bit down, but mostly just sort of flat if you look at it overall. But if you subdivide it, you see that there's definitely some differences in the up and down markets. Roads, bridges, and traffic all up. Rail, airports down. Transportation planning about flat. And again, you see some regional differences, Canada being most positive. If we look at education, the education market, oh, and let me just make a comment. I'll come back to that. The education markets, really not in good shape at all. They were very solid for a long time coming out of the recession, a little late actually. They didn't come out of the recession until about 2012, 2013, but then they stayed positive for a long time. But now they've gone negative, and they've really stayed negative. In fact, there's really no signs of these markets turning up. And in fact, if you look at the sub-markets, every single sub-market in education is down, and every single region is down. Government buildings, similar pattern, maybe not quite as severe as education, but again, we're seeing these consistently negative numbers all along the way, which means month over month, proposal opportunities seem to be dropping. Public safety is not too bad. The rest of the sub-markets are all doing really badly. And you see very much a mixed bag regionally here. You see some regions like Canada and the South doing reasonably well. Other regions like the Northeast and Midwest not doing well at all in this particular market. Water, wastewater. Really interesting. Water, wastewater, if you go back to the last recession, you will see no negative numbers in the water, wastewater market. And it stayed positive all the way through. And again, in this recession, no negative numbers. So that means we did not see a single month that proposal opportunities were weaker than they were the previous month. And if you look at the sub-markets, every single sub-market is positive, and every single geographic region is positive, with the exception of the Midwest, which is about neutral. So it's really interesting if you compare the water wastewater market with some of these other public sector markets. I think one of the reasons that we're seeing the strength in water wastewater that we're not seeing in others is that, unlike most public sector markets, water wastewater is not very reliant on tax revenues. They tend to get their revenues from user fees. So as long as people are staying home and flushing toilets and turning on the tap, which they're doing a lot of these days, water wastewater agencies are flush with cash, forgive the pun. And I think that's what differentiates them from a lot of the other public sector markets that are much more reliant on tax revenues, which have really taken a hit. If you look at environmental markets, they're also overall, we saw a bit of a dip, but not a terrible dip. A couple of months where the index was negative, and then it recovered, stayed flat a little while, and now it's actually into mildly positive territory, and it looks like that may actually be accelerating and the positivity may be increasing. You don't really see that in the sub-markets. What you see is really, really solid waste disposal sub-market, a really strong resource management sub-market, and the rest of the sub-markets are relatively weak. Looking at it regionally again, same story, Canada leads the pack. No regions are negative. They're either neutral or positive in terms of the environmental markets. Healthcare market. In the healthcare market, we really didn't see very much of a dip. There was a little bit of a dip here right when the crisis hit. A lot of the healthcare providers were having some revenue problems, but they seem to overcome those, and they seem to be allocating more money for capital projects, because since then, the plus minus index in proposal activity has consistently grown. And you can see also in the submarkets, every submarket is positive and every region's positive. And this is something we almost never see. In Canada, every single person who responded to this question said that they, in the last survey, they saw more proposal opportunities in this month than they did the previous month. Housing. Housing is hot. What you can see here is it took a dip, a fairly sizable one, down to minus 19, the next month minus 27, but then only minus 7, and then started going into positive territory. And you can see that positivity is actually accelerating. And this most recent data is a plus 38%, which is very strong. And so when we look at the submarkets for the housing market, what you see is they're all strong, with one exception, condominiums, which are just sort of flat. Regionally, this is one market that's consistent. This is what it looked like in last year. And so you see that some are a little stronger than others, but overall, the housing market looks really, really good. I'll talk more about that in just a little bit. So, highly recommend that you get these market forecasts every quarter. Right now, we're actually doing them every month. And we're doing kind of an abbreviated version in between the quarters, and during the quarters, we do the whole version with all the markets and the submarkets. And there's several ways you can get it. We're happy to sell them to you for $247 a quarter. We're even happier to give them to you for free if you're a PSMJ member. And if you don't want to do either of those two things, all we're asking is 5 minutes of your time, participate in the survey, and we will also send you the results for free. So if you're interested in getting those, and I really, really recommend that you do, because right now things are happening awfully, awfully quickly, and you need to keep up with it. So here's the link to be notified and participate in the next survey. Like I say, if you're a member of PSMJ, you automatically get the report. You don't have to ask for it or anything. We'll just send it to you. So let's go beyond the current situation, and let's look at what the new normal might look like coming up when this whole pandemic thing is done. And I'm going to look at it from a market standpoint, not from an internal standpoint. So anybody that has listened to me talk about the economics of our industry knows that I really feel strongly about how important housing is as a driver for our markets. If people are building housing, they're building shopping centers, strip malls at least, not big shopping centers anymore. They're building big box stores, they're building roads, bridges, water systems, wastewater plants, schools, energy distribution systems, courthouses, libraries. About 80% of our market is driven either directly or indirectly by the housing market. And so let's take a look at the housing market. And there is very good news here. This is new residential sales for new homes. And you can see it's since 2015, it's been kind of a gradual uptick from about 500,000 new homes per year, and going up and up and up. And before the recession, or before the COVID pandemic hit, we were up to almost 800,000. And then all of a sudden, boom, the pandemic hit. But look what's happened since then. By August of this year, it's actually gone up to over 1 million, way more than it was even during the best days pre-pandemic. And so this is really, really positive news for our industry. If you want to break it down geographically, you can look at it by region based on pending new home sales. And this index says that there are 32.8% more pending home sales this August than there were last August. Breaking down by region, you can see that the strongest is the South. Next comes Midwest, and then the West, and in fact, the West and the Northeast and the Midwest are all pretty much the same. The South really being the standout for new homes. We also track specifically new subdivisions, proposal activity for new subdivisions. So let's take a look and see what that tells us. Here you can see during the recession of 2008, we went down to a minus 89 plus minus index. Almost 100% of the people were seeing decreases in proposal opportunities. It took a long time to get back up to zero. It took until like 2012. But since then, it's been pretty nicely positive and, bouncing around in the 15, 20%, 25% range, which is very solid considering it's quarter over quarter. And then it took a hit. The next month, it took a little bit less of a hit, or the next quarter, it took a little bit less of a hit. And in the third quarter, it actually has gone positive by a significant amount. And so it looks like the dip is over and people are seeing more opportunities. So this very much reinforces what we're seeing in the national data. Some of the markets are going to be down for a long time and may not come back for many years. Retail stores, conventional retail stores, even before the pandemic, were already struggling, and a lot of retailers were shutting down, including JCPenney's, who've been around for, 150 years, I guess. And so if you're working in this sector, working for retail, not 100% of the retail, there's some elements of retail like grocery stores and such that are still doing well, but the majority of retailers, that market is not only down now, but it's going to be down for a long time. People have gotten used to buying things online, and I think even when they can start going to the store again, they're going to continue to buy a lot more online than they ever did. Office space is another one. People have gotten used to working from home. We have another webinar I'm going to tell you about a little bit about the impacts of working from home on our industry, but it's not just our industry. All over the economy, firms are finding in all kinds of service industries and all kinds of industries that they don't have to have their people all in the office anymore. And I noticed, for example, the New York Daily News, which is at one time was the largest distribution newspaper in the United States, has permanently closed their offices. And now every single reporter, every single worker for the New York Daily News is working from home. So what that means is office space there's going to be a glut in the market on office space. Nobody's going to be building office space. So any A&E firms that have been relying on that source of revenue, they're not going to be doing well. Universities, I think, are another one. The universities went on a huge capital expenditure binge over the past 10 to 20 years, upgrading all kinds of facilities to make the university experience more pleasant for students. However, one thing that hasn't been so pleasant for students is the amount of student debt that's been accumulated to pay for the ever-increasing tuitions to pay for these capital programs. Even before the pandemic, we were seeing a slowdown in capital expenditures by a lot of universities. That's really being accentuated now. And so I think it's going to be a long time before we see any kind of a building boom in capital facilities for universities. There'll still be a lot of maintenance work, a lot of upgrades, a lot of energy efficiency improvements, that sort of thing. But in terms of new buildings, that market's going to be down for a while. On the other hand, there's some other markets that I think will actually benefit from the pandemic. People are going to be retrofitting a lot of HVAC systems to be more protective against viruses, not only the COVID-19 virus, but other viruses that may come down the line. I think that there's been all of a sudden a big awakening to the threat of pandemics. And I don't think people now are thinking that COVID-19 is the last pandemic. In fact, it wasn't even the first pandemic. We've had several pandemics. We've had Ebola, we've had AIDS, we've had Legionnaire's disease. All of these have hit us. But what's been interesting up until now is that all of the previous pandemics, things like Ebola, I think is a classic case, high fatality rate. Somewhere between 30 and 50% of the people that got Ebola died from it. The good news about Ebola and other similar viruses is it's very hard to catch. You didn't just get it by breathing the air. You had to actually have significant blood-to-blood contact in order to get Ebola. So even though it was extremely high fatality rate, it had a very low transmissibility rate. COVID-19 just the opposite. Has a very high transmission rate and a pretty low fatality rate. But one of these days, we're not going to be so lucky. And one of these days, a pandemic is going to come along like the bubonic plague did back in the Middle Ages, or like the Spanish flu did in 1917. And it's going to be a combination of both very highly transmissible and very high fatality rate. And so I think we're going to see a lot more preparations for that day. And that's going to include a lot of retrofits of buildings to make sure that the systems have adequate filtration to filter out those viruses and not have them recirculated around the building. So I think that market's going to be really enhanced for a long time. Medical in general, I think people are going to continue. I mean, medical was growing anyway. Just the aging population in the United States and Canada is driving that. And then when you throw on top of that the need to protect against future pandemics and other kinds of outbreaks, I think we're going to continue to see a very, very strong, in fact, even stronger medical services market. And then the last one that I'm talking about here is water wastewater. Not only are the revenues protected against economic collapse that causes taxes to go down, but maybe even more important, there's been a lot of concern that this is, for those of you who don't know me, my technical background back when I was actually an engineer was water wastewater. And for many years, decades, there's been lingering concerns about waterborne viruses. Well, COVID-19 is an airborne virus, but there's nothing that says that the next pandemic won't be a waterborne virus. And I think that we're going to see a lot of water and wastewater agencies start to attack waterborne viruses in a much bigger way. And that's going to lead to a boom in that market. Big unknown, state and local government markets that are driven by tax revenues, things like transportation, for example. If you compare the 2001 recession with the Great Recession of 2008 and the current recession caused by COVID-19, what you can see is the state budget shortfall in this current recession is much more than it was in the two previous recessions. And for agencies like transportation agencies, that can be a real killer. In transportation agencies, I think, have a double whammy. Not only has their tax base been seriously eroded, if people start staying at home and not commuting as much as they were, the demand for increased expenditures on roadways and bridges is going to be reduced. And if and when automated vehicles ever come in and vehicles can drive much closer together and provide a lot more capacity, it can be reduced even further. And as states and possibly the federal government, if the Biden administration gets in this year, and California's already done this, is to impose a requirement. I think in California now by 2035, I believe it is, there will be no more gasoline vehicles. Well, what's that going to do for gas taxes? So I think that the whole picture about tax-driven public agencies is really cloudy. And you can look at it geographically by state, because some states are in much better position to take care of this than others. The ones in orange have very low reserves. The ones in gray have reasonably good reserves. And so if you're operating in one of the gray states, you're probably not going to be as affected by this as you are if you're operating in one of the orange states. The big unknown is the federal government going to come through with a stimulus bill that includes money that's earmarked specifically for state and local government agencies? Right now, the House version of that bill has about $500 billion earmarked for state and local agencies. The Senate version of that bill has $0 earmarked for state and local agencies. And so if there's a bill at all, there'll be a question as to how much, if any, money goes to those agencies. And I think that's going to have a lot to do with the workload of firms that operate in those market sectors. So here's our latest prioritization. The market, and we look at three things. The short-term prospects are primarily, we look at those based on our proposal plus minus index. The long-term prospects, we look at some of the longer-term trends like I just talked about. And then historic profitability, we actually have data for the last 12 years that tells us how profitable certain sectors are compared to other sectors. So we combine all three of those factors, and it gives us a total point score anywhere from -6 to +6. And these are our current ranking. And I can tell you, this is changing rapidly. I did this just 3 months ago, and this picture looked completely different. So it's something you really do need to stay on top of. Another interesting thing that's happening, and I'm not exactly sure why, but all of a sudden, there has been an explosion in new business formation. If you look at new business this is not just A&E industries, this is the entire United States. You can see new business formation here. The number of new business applications was kind of, floating around here, around 300, 350,000. All of a sudden, boom, it's up to about 475,000, just like overnight. And there's differences by states here too. And so you can see the bluer states have less new business formation, in fact, negative, whereas the bright orange states have the most business formation. So what that means is, assuming that the A&E industry is like an AEC industry, is like other industries, and I think it probably is, you're probably going to have a lot more competitors than you had before. So let me give you 6 specific suggestions that I think you can be doing right now based on all the stuff that we're seeing. Number 1, strategic planning. If you have not revisited your strategic plan lately, it's a really good time to do that. 3 specific things that you should be looking at. Your markets. Are you in hot markets that look good now and in the future? If so, how do you take advantage of that? If you're in cold markets that don't look like they're going to get better, how can you pivot into better ones? And the third thing to look at is, which we really haven't talked about here, what is your long-term work from home plan? What is your plan for the combination of people working from home and working from the office? Are they going to all go back to the office? Are they going to all stay at home? Some combination? What combination? All these are really important things to be looking at now. Second thing, and I mentioned this before, watch our market surveys. These things are changing on a monthly basis, so keep up with it. Third recommendation, we've done some surveys, and what we found is a number of firms have seen a drop in project profitability with project teams working remotely at home. If you're seeing that in your firm, it's really a good idea to invest in improving project management, because we've seen that firms that have good project management have actually seen an increase in project profitability rather than a decrease. Number 4, this is the time to reinvigorate your efforts to develop your current staff and recruit top-notch new talent. As I showed from the data from the Department of Labor on hiring, firms are hiring again. The labor crunch that we saw last year, it's coming back, and it's coming back with a vengeance. Number 5, be very worried about that graph that I showed with all the new business formations. The worst thing that can happen to your firm is for your best people to bail out, set up their own firm, or join a competing firm, but particularly set up their own firm, and then become your toughest competitors. So what you want to do is you really need to look at your ownership transition plan. You need to look at who your best people are, the people you absolutely want to keep. You need to bring them into ownership now. And the last thing is, it's a great time for an acquisition. If you're in the market looking for a firm, there's a lot of really good firms out there. It's a great way to pivot into some new markets. For example, there's several firms that we represent that are, fairly small firms that specialize in water, wastewater. Great time to make an acquisition of a firm like that. We have a new service we call AEC Match. It's an app. You can go online to this website, and you can list yourself as either a buyer or a seller, both confidential. check it out. It's a great way to do that without having the expense of hiring a consultant. I've talked really today about the external market effects of COVID-19. On November 5th, we have a webinar that I'm going to be doing talking about the internal effects of COVID-19. In particular, what have we learned from all the months of working from home? And there's a link to that if you're interested in joining me. I think that some of the finds we have there are very interesting. So, we have any questions?
All right, thanks, Dave. I'll actually start my video again here too. Hey, here's a question. And by the way, folks, yeah, we have a few minutes here. If you have some questions, enter them in there. We'll try to get to as many as we can in the few minutes that we have left. Dave, what do you make of, some of those markets, other government buildings, for example, that's down quite a bit and could be for a while, but they're often buoyed by the housing market, and the housing market is on fire. So any advice to the firms that are in some of those markets that in theory are tied to the housing market? Should they just sit tight? Are good times ahead, or what do you make of that?
So I think you have to be very careful to not fall into the trap of looking at how good a market is based on how much demand there is for that market. And that's what people tend to look at, but demand does counterintuitively, demand does not drive markets. If demand was what drove markets, we would all be working on projects in Africa, because that's where the big demand is. What drives markets is money. It's the funding to pay for those demands that really drives the markets. And so there may be a lot of demand for government buildings, but if there's no tax revenues and there's no money to pay for them, they're not going to get built. And so I think you really have to follow the money, much more so than just the demand.
Yeah. All right, thanks. Hey, Dave, on the environmental submarkets, one of them is resource management. Could you provide a little more clarification on what that is?
Yeah, it's basically looking at companies that use resources and helping those companies use those resources in the most efficient and effective manner possible. And it's a very nice little consulting niche in the environmental business.
All right, thanks.
And also helping them minimize waste products from their resources as well.
All right, thanks. Again, reminiscing of the in-person Thrive, I can remember in the 2016 event, I think we were in Nashville, there was a whole bunch of talk about the impact of the election on the, AE markets. Just kind of quick overview, impacts Democrat, Republican on some of these markets going forward. Any thoughts?
Yeah, there was a great analysis I just read yesterday by one of the financial investment firms, and I really agree with it. And their analysis was, you know what? It's not going to make much difference. Things are going to, despite all the stuff that you hear, either how wonderful things are going to be under whatever candidate or how terrible they're going to be under the other candidate. If you really strip it all down, there's not going to be that much difference, especially in our industry. And I think the stock market bears that out. Back when it looked like Bernie Sanders was going to win the Democratic nomination, the stock market did not like that, and it tanked. But as soon as it looked like Bernie Sanders was not going to be the nominee, the stock market said, okay, fine, we can live with Joe Biden. And as the weeks and months have gone, Biden's lead has consistently increased and his odds of winning consistently increased, and the market keeps going up. So I think the market doesn't really care who's going to win, and I don't think it's going to make that much difference to us either. It may make a little bit of difference around the margins. Probably the biggest difference, although both Trump and Biden express a desire for more infrastructure spending, in 4 years of Trump, we haven't seen it. Maybe we'll see it under a Biden administration. I don't know. But I'd say the odds are probably better that we'll see infrastructure funding under Biden than we will under Trump. Mm-hmm. But who knows?
Who knows? Yeah, we had a guest on our AEC Senior Executive Briefing, and that's a broadcast, by the way, if you remember. It's another benefit in addition to the quarterly market forecast from the U.S. Chamber of Commerce. And he had said the same thing, Dave. Yeah, that Trump's an infrastructure guy. He's going to want to leave a legacy in a second term. He's going to make that a priority. And of course, the Democrats, absolutely. So either way, there could be a potential upside. Dave, you mentioned something that was really interesting, drop in project profitability as a result of the work from home. That almost sounds like what that comment I made from Ren's early on that kind of exposes organizational weaknesses that existed before. Can you talk a little bit more about that, how that manifests itself?
You know, what we saw in the data, and I'll be presenting this data in my November 5th presentation, is that it's very much a function of firm size. Firms of under 100 employees in general have seen drops, significant drops in a lot of cases in project profitability, whereas firms of over 100, particularly over 250 employees, have actually seen increases in project profitability. And I think what that says is exactly what Renz was talking about. The larger firms tend to have more structured project management approaches. The smaller firms tend to just project manage by the seat of their pants. Well, when everybody's together, you can get away with managing by the seat of your pants. But when your team is scattered into every household that there is, the seat of the pants method doesn't work very well anymore. And the more structured approach works a lot better. I think that we are going to continue seeing a lot more work from home. That's not going to end. And so I think even the smaller firms are going to really need to have more structured project management like the larger firms do if they really want to improve project profitability.
Yeah. All right, we got to leave it there. But thank you so much for those of you sticking around. 2:15 Eastern time, that is. So about 15 minutes from now, we will start our public sector panel. I think that Dave's presentation was just a great way to kind of lay the groundwork for a market that for now is doing really well. But you know, that potential dip in tax revenue could be problematic. So let's tune in 2:15. We'll talk to some folks on that and dig and try to unpack that a little bit and see what it means. Dave, thanks so much. Thanks everybody for attending. We'll see